This is a FarmDoc Daily webinar. I'm University of Illinois Extension's Todd Gleason. Today, lease arrangements and ownership from the landowner perspective. We're joined by Gary Schnitkey, University of Illinois agricultural economist, and Luke Worrell. He's with Worrell Land Services out of Jacksonville, Illinois, to take us through a series of information related to the perspective of the landowner on lease arrangements. So this is an interesting topic. Gary, thank you for being with us. Can you give me a quick outline of what we can expect for the next hour or so?
Yes, thank you, Todd, and thank you all for being here. This webinar actually resulted from a number of comments on our previous webinars, and we often get the question about basics for landowners, what to consider in lease arrangements and ownership considerations. We are going to divide this up into three topics. I just inherited farmland. What do I do now? So just some basics. If you just inherited farmland or come into acquisition of farmland, what do you need to do now? We'll talk about lease arrangements and the difference of the four major types of lease arrangements that exist, and what are some of the advantages and disadvantages of each one of those. And then finally, we'll talk about selling and transferring farmland to the next generation. I am Gary Schnitkey. I'm a professor and extension specialist here in the Department of Agriculture and Consumer Economics. Luke Worrell is a farm manager and deals with these issues all the time. He's a practitioner, a member of the Illinois Society of Professional Farm Managers and Rural Appraisers, and also is the chair of the Land Values Survey that the Illinois Society does, that University of Illinois is heavily involved with. Luke, do you just want to introduce yourself a bit and what you do as a professional farm manager?
Yeah, absolutely. I appreciate the opportunity to be on with you, Gary. And as Gary said, Luke Worrell, our office of Worrell Land Services is here in Jacksonville, Illinois, and family owned and operated. We have one location here in West Central Illinois, covering about 10 to 15 counties. And so the three major facets of our business is farm management, agricultural real estate, and agricultural appraisals. So certainly kind of deal with some of the topics we're going to be discussing today quite literally on a daily basis. So happy to be here and to give kind of a quick overview.
Yeah, and again, we're doing this from the landowner's perspective, and we're just going to start here with the first topic. I just got farmland. What do I do now? And this actually is a question that I get every now and then. You know, an individual inherits farmland or buys farmland. But one of the things that those individuals that inherited farmland and they now maybe off the farm and maybe a generation or two removed from the farm, what do I do now? And the first thing that I would start saying to them is that you do have a valuable asset. So some individuals may be concerned that they need to sell this asset, move the money elsewhere, and get a higher return. And I would caution against that, I guess. Historically, and again, we can't say what the future looks like, but historically, farmland has had returns near stock market returns, and those returns are roughly comparable, maybe a little bit less than stock markets, but a little less variable. One of the characteristics of farmland is that it has low current returns, which means if you take the cash rent from the farmland or the share rent return, if you're a share rent landowner, subtract the property taxes and any other cost associated with owning the farmland, that amount is typically 1 to 2% here in recent years of the value. The current return, or that which is the cash return from that individual operation, has been relatively low. That has been a characteristic of farmland for a long time. And actually, if you look at those current returns over time, they closely follow what's going on yields on treasury notes. So as those treasury note yields come down, so do the current returns on farmland relative to the asset value. And typically, the capital gain or the growth on the farmland makes up the largest percentage of the farmland return. And farmland is a growth asset. And again, most of the farmland return is in its capital gain, which have been good in recent years. Luke, what is that a conversation that you often have, and what would you tell them, and what would you add to that?
Yeah, no, I think you covered a lot of good information. I mean, just based on the slide we're seeing now, I think just a few maybe add-ons. Gary hit the nail on the head that, it is definitely a more stable investment, I guess. It's not, we see volatility, obviously, but there is not as much variability to the land market as a stock market or other assets that aren't tangible. The 2% of value is spot on too. I think sometimes there's some misconceptions that it would be higher, but if you look at how valuable Illinois farmland is, you typically are in that 2 to 3% range. Now, other parts of the country you might be higher, but that's certainly, in my time in the industry, has always kind of been that 2 to 3% of value range. I know we have a lot to cover, but in this, as obvious, goes without saying, perhaps, but every farm and every family is uniquely different, and so you really need to assess the situation. And I will be speaking more on this later, but I think rushing into selling an asset, unless the circumstances just absolutely call for it, I think would be a mistake. So I would make sure you do a lot of due diligence, speak to professional, and don't rush a decision.
Yeah, and again, that rushing the decision, when you have a large asset, there can be some tax considerations and capital gains associated with this, so don't rush that decision. Farmland has grown quite a bit in price or its values over time, and a great deal in the past couple years. Again, we've seen those farmland prices, and this shows for the state of Illinois. You would see roughly similar things if you're looking at any individual area within Illinois and across much of the Midwest. We have had large increases in recent years. Sometimes you get concerned about price falls. I have no ability to predict a price fall. I personally actually don't believe we're looking at a potential for a large decline now. But what people do get worried about is the 1980s, when we lost quite a bit of our value of our farmland. Again, that is always a possibility, but not a likely one. And I would also suggest that if you're thinking about taking this farmland investment and placing it someplace else, the potential of declines is there as well. So it's been a good investment over time, and chances are it will continue to be a good investment in the future. If you continue in the farmland, and here Luke I'm going to go over these quickly and then let Luke cover these. So some of the task of the farmland owner is that you have to select a tenant, you have to determine and manage a rental arrangement, so owner can continue to own that farmland. They can continue to use the farmer that that has farmed the farmland, or find a new one. Determine and manage a rental arrangement, assess the property, and keep that up to date, and ensure all long-term investments stay in good place. Luke, just take us through some of the things that you do as a professional farm manager, and what goes on here.
Yeah, absolutely. So, I think You know, a lot of times when people come into farmland or inherit farmland, there is the chance for some deer in the headlights kind of feelings. You know, to me, and I spoke on it loosely already, is to not rush a decision. I think it's important to, you know, you see right there, assess the property. I take that as, you know, almost assessing the situation. If you aren't familiar with the land, try to become aware of, you know, what had been the rental arrangement in the past. Who is the current tenant? It's very possible that the current tenant is, you know, is a great operator and somebody you should continue working with, but try to understand exactly what has been taking place in recent history. You know, also, if you inherit land, there's chances are you can also look at the assessing the property as trying to establish a value. I mean, Gary just mentioned how we've seen exponential growth in the last 2 years, especially. You know, upwards to 40% in land value increases for Class A land. So you really need to kind of keep your ducks in a row. Also, you know, in regards to long-term investments, you know, a lot of times farms come with grain bins, maybe a high dollar field tile involvement. You know, maybe an old farmhouse that's a rental. So there are a lot of things to consider. You know, as a farm manager, we try to get a clear picture of every nook and cranny of what a property has to offer, what it's been doing in the past, and how can we make sure that this asset is meeting the landowner's needs and their goals. And I think it's important to realize that, you know, I mentioned on the first slide, and I'll probably beat that drum over and over, every farm, every family, uniquely different. The goals aren't always the same. Some absolutely might be all about what is my bottom line. Some might have a sentimental attachment to the farm and want things done a certain way. And so sometimes those goals are a mix of both. And so I think it's important to get a clear picture of every detail and determine what do you see as the future of your newly inherited land. Obviously, I'm a farm manager, so I think, you know, we can play a great role. I mean, especially if you look at Illinois, there is a ton of absentee ownership. And so, yeah, why there is a vast majority of the growers are entirely trustworthy. But to have somebody there to implement your goals, keep you abreast of all of the options and all of the things in agriculture, because agriculture, that sector moves quickly just like everything else. And so I think a professional can give you a lot of peace of mind and some great communication. But those are some of the first steps.
Yeah, so those are first steps. Many farmers or many landowners manage their own farmland. And again, we do have a professional farm management is an option. And and I would also point out that there is the Illinois Society of Professional Farm Managers and Rural Appraisers. If you go to their website, you can see some of their services and go to their land values book, and you will see some of the farm managers and other professionals in that area. We at University of Illinois, Department of ACE, have a very close relationship with the Illinois Society. They actually started in Mumford Hall many years ago. Luke and I were not born then, but when it started, and out of that also sprang the American Society of Farm Managers and Rural Appraisers. We have two questions, and both of these are very good ones. It is confusing to determine the future productive use of farmland. One of the things, we aren't going to go through that question in detail, but I would also go to our webinar series, one by Bruce Jones, Luke, and myself about a couple of weeks ago. And we do talk about farmland values and putting those in a historical perspective. I personally, there are obviously headwinds there. But there is also large demand by the man. I said Bruce Jones, I meant Bruce Sherrick. Thank you, Jim, for correcting me. Bruce Jones is a friend of mine from a very long time ago, by the way. All right. So don't be in a hurry to sell it. You can make a rational decision to sell it, but take your time thinking it through. We're going to now turn to leasing arrangements, and there are a number of leasing arrangements that exist out there, 4 large ones. And just setting this up, a leasing arrangement typically is a year-to-year lease. There is typically, often, actually, this is the way the University of Illinois leases are set up. It's a year lease, but if no one says anything by a certain date, it continues into the future. If you do not have a written lease, changes need to be made in Illinois by October 30th. That is a state statute that was put in place. So October 30th is the rough guideline for when you have to have lease terms changed if you don't have a written lease. We are going to talk about leasing arrangements, and we're going to list 4 of those that are pretty common in Illinois. And we're going to discuss those as far as these 3 characteristics, and they will vary by lease type. Management by the tenant. How involved does the tenant and landowner have to be in the management? Risk, and this deals with the landowner. What is the risk once the lease has been signed? And the third is difficulty in setting lease terms each year. So the 4 lease types that we're going to look at are share rent lease, cash rent lease, variable cash rent lease, and custom farming. And if you look at those characteristics, and from the landowner's perspective, the management on the share rent lease is, I would characterize it as a medium level. And as we go through this, you're going to see that you're going to have to, the landowner will generally have to market the grain. The risk on a share rent lease is medium to high, and the medium to high means that there is a chance that the lease payment to the landowner could vary within the year. And the difficulty in setting terms each year are very low because the lease term doesn't change. A share rent lease is where an individual shares the lease, the landowner and owner and the farmer share returns. And we're going to describe each one of these in more detail later. Cash rent lease, the farmer pays the landowner a fixed cash payment. Generally speaking, the management is low. The risks are low because we've set the cash rent payment. But I would argue that the term setting the terms each year is difficult because you always got to agree on the cash rent, which can be difficult in times of changing lease. Farmland returns. Variable cash rent lease, the management I would argue is low. Risk is medium because the variable cash rent will vary the lease payment based on generally gross revenue. So there's more risk to the landowner. And the term difficulty is medium because you still have to think about the lease terms. But it's not as hard as the cash rent lease because the variable cash rent lease parameters stay roughly the same. Custom farming is where the landowner hires a farmer or individual to perform all the field operations. The landowner buys the seed and all the other inputs and markets all the grain. In this case, the landowner is roughly acting as a farmer, just hiring the field operations. Management is high, risk is high, and the term difficulty, setting the terms is probably of the medium order. Luke, do you have anything want to add here at this point before we move on?
No, I think we'll dive quite a bit deeper as we move forward.
And just to give you a feel, this is what the farm managers, those Illinois Society of Farm Managers and Rural Appraisers, what they say or what they indicate the percent of their farms are managed by each one of these agreements. Custom farming is the lowest number, 5%. variable cash rent is 31% and cash rent is 26%. The share rent, sharing of the revenue and cost is 26%, and 12% are modified share rents, which means that the share rent is modified by some term, and we'll talk about that as we're going through. Over time, we have seen a shift away from share rents to cash rents, and we've also seen amongst the Illinois society a much higher use in variable cash rent. I would attribute that to the much more variable prices in particular that we've seen in recent years, which causes cash rents to be more difficult to determine. Is those the trends, Luke, you're seeing in your practice as well?
Yes, they are. And I think, it's important for some context. I mean, we've been, tracking this question throughout the Illinois Society survey for years, and it hasn't been like a huge sudden fluctuation, but it has been a slow and steady kind of swing towards this variable rent. This you might hear the term flex lease. I think that kind of falls into this category, and so. To me, this was one of the more interesting findings of our mid-year report. This is the first time I can remember, and probably ever, where this variable cash rent or flex lease is expected to be the most prominent or widely used lease in 2023. And I think you hit the nail on the head again, Gary. It's entirely related to kind of the volatility and the heavy shifts we see in day-to-day life here in 2022. I think, and I'll have a few more comments on that as we talk about these variable cash rents, but I think it does a great job of trying to encapsulate what happens in the given year, in the given crop year, that is, and so it can be viewed as more fair, more favorable to what actually transpires.
Yep. So now we are going to go through each one of those leases, starting with a share rent lease in more detail. A share rent lease is one where the landowner and tenant share in input cost and revenue. So typically the landowner and tenant share in the seed, fertilizer, herbicide, insecticide, and fungicides. Those costs are shared, and we'll get into the shares, which do vary across Illinois. The landowner typically receives the grain. So the simplest case would be the farmer harvests the grain, takes it to a elevator or delivery point, and the landowner would take title to that grain at that point in time, and they would pay storage and drying on that grain. The landowner would also share in commodity title payments, and these would be ARC County and PLC payments, and those would come in the equal share of the revenue share that the landowner receives. That does mean that the landowner will have to deal with that farm service agency and go in and sign the paperwork, or go in may not occur anymore, but we'll have to deal with the paperwork from farm service agency. Luke, what would you add here?
Yeah, this is you'll hear this described as your typical, your classical 50-50 arrangement. Some other things that come up here. If you are doing this, yourself without a manager, you would need to market your half of the grain. Decide who exactly is going to make the seed, fertilizer, herbicide, insecticide decisions. Is that the tenant? Is that a collaborative effort? And just a few other things that you would need to do on your half or your share of the crop that wasn't on there is crop insurance. Not only the FSA paperwork would be your responsibility, but are you going to have crop insurance for your half of the grain? Of course, we're talking multi-peril and crop hail and things of that nature. So that probably, several generations ago was the most dominant lease, I would guess, but it has slowly been chipped away at by cash rents and variable leases.
Yeah, I think you're right, Luke. This was the basis of the beginning of the rental market. The crop insurance is an good issue that landowners. I would encourage landowners to purchase crop insurance on their share of the acres, making those arrangements and getting that done. Typically, or in many cases, the landowner will be making payments in spring for the crop cost, and then we'll receive the grain. So there are some cash flow considerations here as well.
Mm-hmm.
As Luke mentioned, were you?
No, I just was going to chime in. I think that's a great point too, is, depending on the situation. I mean, I know we have owners who like to get expenses done by the end of the year. Some get income by the end of the year, and some are the complete opposite. So again, it kind of comes down to staying flexible and kind of tailor making your management approach based on the actual familial situation.
And again, sure rent, you as a landowner will have a lot more decisions to make. The other thing, and again, in northern and central Illinois, we're typically see a 50-50 landowner sharing percent. The landowner gets 50% of the grain and pays 50% of the crop costs, those seed, chemical, fertilizer costs. And we often see an additional rent of $25 to $35 per acre from the farmer to the landowner. So, and that is the part of the lease that's the modified lease. That has grown up over time, and it's fairly prevalent, but not universal. That is a pretty common split in northern and central Illinois. The splits become much more varied in southern Illinois. We have some 2/3, 1/3 relationships where typically in those cases, the farmer pays all the seed costs. You will see some 50-50 and 60-40s in southern Illinois. And that will also, the split of those will depend on tradition and also just the productivity of the farmland. The more productive of the farmland, the more you see 50-50s. The share rent lease, the landowner will pay all property tax and maintain land improvements. And the land is the landowners. Therefore, that landowner will pay the property tax and maintain land improvements. Luke, you have some issues to add here?
No, I think this is entirely accurate. If it's your land, you pay the taxes. Maintain land improvements. What I will mention is sometimes, as you can see in the picture, that's obviously some field tile of some sort. Some large scale capital improvements typically fall on the landowner's side of the expenses, but there are situations where there is some collaboration in regards to getting a large scale tile project done or some of these other larger projects. Also, depending on the relationship and the history between landowner and tenant, a lot of times, what are those land improvements that aren't big but aren't entirely small, like repairing a dry dam or replacing a riser pipe? Those are the kind of things that sometimes, based on the situation, a tenant will take care of. But large-scale land improvements, capital improvements, and property taxes, they almost always fall to the landowner.
Under a share rent lease, the farmer pays all machinery costs, including the fuel, including pretty much everything. One of the issues that we often see or often hear about is lime. So lime is applied and typically has a life of 4 to 5 years. So if a farmer makes a lime application in this year, that lime will have a life of 4 to 5 years, depending on application timing. We see, and I would suggest that in those cases, if the farmer pays for the lime, that cost is prorated. If the lease is broken, the landowner will make a payment to the farmer for the lime. So that Luke, what's your thoughts on on that as well.
Yeah, that is typical. Like anything, there are a few exceptions, but I've seen it done exactly how you mentioned it. We typically prorate it over 4 years. Very rarely does it become an issue, but occasionally, yeah, you would need some reimbursement for some lime that you as a grower didn't get the full useful life out of.
And if you want to see, if you go into the management section of FarmDoc, and again, if you're working with farm manager, they will have their own lease forms and lease agreements. But if you want to see some that were put together by the University of Illinois, go into the management section of the FarmDoc, go into Farmland Leasing. You will see a cash rent lease there over on the corner, and there are all sorts of leasing arrangements. There's one for fixed cash rents, and if you keep going down there, we have conservation endorsements and some variable cash leases as well. All right, that's a share rent. Here's a cash rent lease. Here, the farmer pays the landowner a cash rent per year. So this is relatively simple, except for determining the cash rent, and that's often
Yeah.
often the sticking point, I suppose. And obviously, farmers don't want that to come up, and landowners don't want it to come down. So there's a deal behind that, and payments can, and typically those cash rent payments occur once a year, generally before planting, twice a year, once before planting and once after at harvest, and more times you could have 3 payments if you want. I would say over time I've seen a shift from twice a year to once a year before planting, and that probably has resulted in recent times because interest rates have been so low. Anyway, Luke, cash rent leases.
Yes, very. I like the way you put it. That it's simple except for the rate. But yeah, and I think one of the things we've seen, especially in recent history, and one of the reasons I personally feel we have seen kind of the continued shift towards variable leases that we're yet to address is, so right now we're negotiating 2023 cash rents. And I'm a professional, obviously, and Gary, and we it's our job to try to project and get a feel for what is possible next year. But that's a hard business, and so I think cash rents sometimes can be a little reactive to what just happened in 2022. I think a lot of times cash rents are set based on what just occurred, but we all know that every year is different, and so it's hard to say, well, what is the right to farm this acreage worth next fall? Because next fall is when the farmer is going to decide if it was a good decision or not. We're kind of projecting retroactively, and so that's tough. And Gary, I think you're right too. I think we had seen maybe more, once a year payments, a springtime payment. Our book of business personally, we still see a lot of twice a year payments. I think that, is still obviously the same total dollars to an owner, but helps the farmer with a cash outlay. Typically we see, the first payment due, March or April 1st, with the second payment either sometime in October or November 1st. I don't see them many times where you do more than twice. Certainly you could. I think that's just more chances for somebody to forget or one more thing to keep track of. So I would say majority of it's twice a year. But, again, we could have a whole nother webinar on cash rent leases and the thoughts behind how to try to formalize those.
So we got a couple questions, Luke, on share rental arrangements.
Okay.
And one of those is, all right, so how does the renter send the landowner invoices for fertilizer, seed, and other operating expenses? And how does a landowner know if any of those supplies are stored over for the following year, etc.?
Great question, and it comes down to clear and consistent communication, and I think that is of utmost importance, whether you are working directly with a tenant or with a manager. I mean, to me, if I was a landowner, I would want to know exactly what's being applied and what's going on. So yes, I would expect to receive invoices for my half of the costs. And I think again, just to talk about communication, I think if there's clear, consistent strategy on a collaborative effort, you're going to know exactly what invoice is for what year. Right now on our 50/50s, obviously we're purchasing fertilizer and seed for 2023. So it is important to know, because there's a little bit of overlay to where you need to know if it's this year or next year.
The other thing that I would say is it does in the end come down to trust. And number two, if you are ever, I wouldn't compare the farm costs you're seeing to Illinois budgets, and they will vary from those budgets because those costs are averages. But if you're curious, am I in the ballpark? Just compare those to what we summarize for FBFM, and again, there will be variation across those. All right, so now we're moving back to cash rent. Well, we got one more question here, Luke,
Okay.
and I'll let you answer this. How are carbon credit payments being included in common lease agreements today?
That is a phenomenal question, and one that I honestly don't know how to answer just yet. I think we're really on the cusp of these becoming a thing. Just cards face up. We have some clients that have interest in carbon credits. I personally have not seen them implemented into a lease just yet, but it would definitely need to follow, those types of payments. If it's a 50/50, one would think you would try to kind of correlate those to how you would handle a CRP payment or some sort of other share.
Yep.
That's a great question. That's a great question to ask in 2 or 3 years. I think we'll have a lot better understanding of how that's being handled.
Yeah, that is true. So coming back now, and by the way, carbon credits would apply to all of these leases, and I would think that in a 50/50 you would be sharing them. And cash rent, I would hope that the landowner or the farmer would let the landowner know that carbon credits are being used there, and then make some adjustment perhaps. On the cash rent lease, we have two sources of information that I want to point out. One of the things that, again, because of the cash rent, we often get questions about what the cash rent should be. And I would always typically point to two pieces of information, imperfect pieces of information, but two pieces of information. One of those are average cash rents, and both of these are on our FarmDoc website. You go to the leasing section, and we keep this up to date. We keep this up to date with the latest USDA numbers on average cash rents. I would warn an individual that the average cash rent gets you in the ballpark, but any particular lease in a county can vary from that average considerably. $50 or more, either up or down. That would depend on productivity, farmland relationships, etc. And actually the desires of the landowner come into that as well.
Correct.
Gary, Todd Gleason here too. I have a question about this I was thinking about yesterday as related to this USDA survey, because it is a current cash rent survey when it is done. How does it account, or does it just simply miss the variable part of the cash rent? And given that 31% of those that are managed by professionals are that way, I would think that would be important.
I think the fact remains it probably has. When it comes to those studies, the real time moves a lot faster than the data can come out sometimes in some instances.
And second, I do not know how USDA handles variable cash leases in their survey. So I don't know how they handle that. The grayed out counties are, by the way, counties that are not reported by USDA. So for whatever reason, they didn't get enough responses in those counties.
Yeah, and I think your next slide, Gary, is probably a much closer snippet of what we see right now.
Yeah, and this is from the Illinois Society. You see, and this is from professional farm managers. It shows through 2022 their actual farm leases and what they were projecting for 2023. And this was done in August, so the things might have even changed since then. But we're expecting lease terms to go up in 2023, largely because farmland returns have been good. So, Luke, go more comments here.
Yeah, no, I think again we could have a whole webinar on this, but yeah, I think this is a much better indication. I think this goes back to what I was saying. I believe if you look back at 2021, where you were, we're about 25% ahead of where we were just 2 years ago. So it's moved pretty quickly, obviously.
Yep. And again, setting the cash rent is always the hard part. And just the characteristic, cash rent is a difficult parameter to determine. Landowners have little management and risk. Once the cash rent is set, landowners still need to inspect property and deal with land improvements. And finally, and I'm going to illustrate this, Luke, comments here before we show the lag nature of cash rents.
No, go ahead.
So this is what I'm showing here. This is from FBFM records. The blue line is what share rent returns to the landowner have done on average, and the green line is cash rent, and the orange bars are farmland returns through a projection for 2022. You can see that share rents react much faster to economic conditions, as you would expect them to, and cash rents tend to lag. So cash rents tend to go up slower than returns do, and they will likely come down slower when returns come down as well. It's sort of interesting over this entire time point, and this will be averages. The average cash rent was $230, share rent was $245, and part of the reason that share rent is higher is because of the last couple of years. Just so you know, if we took the last couple of years out, the cash rent and the share rent would have been much closer. So, Luke, go ahead.
Yeah, no, and I think again, I think it'd be a different viewpoint if you took the last 2 years out. Obviously, cash rents are going to be slow and steady, okay? And share rents is where you're going to see the variability, and you're going to have some good years, you're going to have some bad years. And it kind of goes down to what my grandma always used to say: she doesn't need to go to Vegas because she farms. So that sums up this slide.
All right. Let's go to the third TARP, which is variable cash lease. It's a modification of a cash rent lease, and it does a very good job of considering the impacts of return changes over time. That's the design of a variable cash lease. We're going to give you one example, and frankly, there are many examples here. We're going to give you one example that is on FarmDoc. I'm sure that Luke's will vary from this, but we're just giving an example here. And Luke, you do use variable cash leases, correct?
Correct, and they've become more popular, and I think because they're designed to give a true snapshot of what transpires. We just kind of were lamenting how it's hard to base cash rent on what happens next year. Well, a variable cash lease, if it's constructed well, it bases its rent on what indeed happens, that year. So I know we just have one example, but like Gary said, there are literally tons of modifications you can make. Two things I would strongly suggest to anyone who's thinking about this. One, you want it to be fair and detailed, but there's a fine line between that and overcomplicated. I think you definitely need to try to keep it as simple and straightforward as you can, because there's nothing worse in a variable lease for a landowner and a tenant to be happily going along a year, but unbeknownst to both parties, they have completely different ideas of what is actually structured. So I think it's of utmost importance to make sure everybody is on the very clear same page before a year starts.
Yep, and we're going to go through a simple example here, and you can read more about this in the article that's linked in this slide. But there's several parts of the negotiated parts of a variable lease. Pretty much all of them need, and you actually do need, a minimum cash rent. You need the minimum cash rent to be meaningful so that the landowner isn't going to receive the FSA payments. And that's actually most of these leases, you want the ARC and PLC payments to be going to the farmer so that the landowner does not have to deal with FSA. There is also an additional cash rent. So you have this minimum cash rent, and this additional cash rent will vary based on economic conditions, and that is usually crop revenue. So that additional payment is usually a percent of crop revenue, and when that percent of crop revenue exceeds the minimum cash rent, we will have a payment. A couple other things that you have to agree on is how crop revenue is determined. And in most cases, that's farm yield times the market price. And we would I suggest that market price is an average of quotes on agreed upon delivery point, say Wednesday at some elevator that the grain could be delivered on. Luke, details here.
Yes. A couple quick comments. One, your previous slide, and I think it's important, is, in the era of volatility we're in, absolutely a minimum cash rent, but I think a maximum payment is also beneficial for the farmer's perspective. I think given the volatility, I think that's fair, especially, like we said, there's 100 different ways to go about these, but that way both owner, farmer know the absolute minimum and the absolute maximum. So I think that's important in the age we live in now, is to have that maximum. When they first came out, a lot of them did not have a ceiling, and that led to some pretty awkward conversations based on some of the factors that vary into it. Secondly, on the next slide that Gary just mentioned is, the market, agreeing on, the market price. On ours, we try to use an elevator that typically is where indeed the operator would take the grain. Sometimes getting a quote every Wednesday might be cumbersome and hard to keep track of, but I think you do need to actually have enough dates built in to where you get a true representation of that marketing window that the farmer has throughout the growing season.
The suggestion for minimum cash rents, this is our suggestions at University of Illinois for minimum cash rents, just to get you in the ballpark. I believe Luke would have different ones and probably higher ones in this case, right?
Yeah, so I think a lot of times what we see in our industry of late is you kind of try to gauge what your market cash rent would be. What would happen if this farm was just out there and open, and then you take that number and you scale it back to about 85% of that. So again, you can go about it a bunch of different ways. I think the real life examples that I'm involved in, that I know of, not just within our company but others, I think you'll probably see a little bit higher of a minimum, but certainly a lot of that too depends on all of the extra parameters you have in place.
Yep. And then the rent factor. So this is the percent of crop revenue that will be used to calculate the additional payment or the total cash rent. These were calculated by us here at the University of Illinois, and they, over time, from 2000 to 2020, caused the cash rent to equal the variable cash rent. So if you want to receive more over time, you would raise those rent factors. If you want those to be lower, you would be lowering those rent factors. We have a question about using futures prices in the variable cash lease formula. That is perfectly fine to use futures prices. I would note, though, that futures prices usually are above cash prices. So, and usual basis is about 30 cents. So if you're going to use futures prices, lowering these rent factors would be a good idea as well. Luke, add your wisdom here.
Yeah. Yeah. So, and these rent factors too obviously can change based on how aggressive or conservative you might be on the base rents as well. So, I think if I could hone down even just maybe a little bit more, I think on what I see, typically those rent factors fall, 32 to 38%. I know some of them on ours, just to simplify things, we agree to a straight percentage regardless of crop, just to keep it very, very clear. And then just touching base very quickly on what you just mentioned regarding the question. Yeah, we do use, fall bids, the first Friday of January and the first Friday of May. And you can use futures.
We also have this question. What do you do if you grow non-GMO soybeans if the owner wants the farmer to grow them? How would you do do you have experience with that, Luke?
So I do. I do when it comes to shares. I think it becomes, there needs to be some pretty clear and honest discussions on if you want to handle that with a flex lease, but it's certainly possible. And yeah, that's where I think it comes down to making sure you have a good synergy between you and the grower. But yeah, certainly possible.
It is certainly possible. You would also have to consider there is a premium. There's also likely additional cost associated
Correct.
with production that the farmer needs to be compensated for. Again, those rent factors are just to give you an idea, and we're set so that over time, the average cash rent would equal the variable cash rent. And you can see there that rent will vary from the average cash rent. Again, advantages. Advantages is that they adjust cash rents to varying returns. And so you have less need to renegotiate rents. It's self-adjusting. So, Luke, what else do we need to say about variable cash leases?
Yeah, I would caution. I think they're a great tool. I think conceptually it can be really fair and can eliminate potentially some of those feelings at the end of a season where, a lot of times with the cash rent at the end of the day, some owners or some farmers might feel they had the short end of the stick. But I think, a flex lease is a good way to try to combat volatility and give a true snapshot. So again, keep it simple and keep the communication clear and go from there.
Yeah,
Gary, I have one additional comment here, Gary, as you move on into other parts of the leasing. I did check just now with Lance Honig at USDA NAS in Washington, D.C. about my cash rent survey question and what it does and does not include. It by default excludes both the flex and variable leases, so it is cash rent.
So that would be that's good. Thanks, Todd. Those are fixed cash rents. They do not include variable cash rents, so that's good to know, and that makes I think that's a good approach by USDA. The last type of lease, which we're not going to spend much time on, is custom farming. Again, we don't see many individuals do this, but the landowner pays a flat fee for all field operation. The landowner would buy all the inputs and market all the grains. And this is a high management, high risk alternatives. I would just say that not many landowners use this alternative, and you have to be pretty agriculturally knowledgeable to use this alternative. Luke?
Yeah, I would agree. I think you either have to be very nearby the farm. I would think you would absolutely almost have to have a farm manager in this scenario if you're an absentee owner. And you have to have a good, strong cash position because you're putting a lot of money out there, and you're kind of rolling the dice. So it's the highest of highs and potentially the lowest of lows. So it's about as close to being a farmer as you can.
So we have a question. How often do you need to adjust the base rent? So how often do you adjust the base rent, Luke?
Yeah, no, I mean, to me, and whether it's, listen, I think, we've talked about volatility, and I know everybody's probably sick of hearing that word. I know I'm sick of saying it day to day. But to me, everything is a year-to-year agreement. I think that was on one of your first ever slides in this whole presentation. So I don't necessarily adjust the base rent every year, but I certainly don't lock it in for multiple years. I think it's something you need to look at on a yearly basis. I do think, though, there is value in trying to find a number that folks can live with, and try your best to stay within a range. Just because establishing a variable rent is fairly cumbersome because there's so many factors in play, and you kind of run the risk of confusion and burnout if you try to toy with that every year.
So what do you have what do you know what a rent factor for wheat is?
I do not. That's a great question.
Yeah, we have a question. What is the rent factor for wheat? We don't know the answer, but we will look for that. Send an email to us and we will get back to you.
Yes, I'd like to know that too.
Yeah. Do you have experience or thoughts on implementing leases with conservation clauses? We do have a number of conservation clauses on our website, so you can go there and look at those. And again, this is a matter of communication. What does the landowner want their farm to what conservation practices that they want on that farm? And then you have to determine if those conservation practices need some adjustment into the cash rent or the flexible cash lease. Luke, comments there?
No, I think you covered it. I think you covered it well. It's a lot to get to in an hour. This is challenging.
Yeah. We're getting a lot of questions here. We got one more. Custom farming. This may be a little bit dated with I've always heard custom farming rates started in the 120 to 130 per acre range. Is that what you're hearing, Luke?
Yeah, I mean, what we try to do, obviously not, cheap plug for U of I here for you, Gary, but I mean, you guys put out, custom harvest operations. There are other, institutions out there that put out like an acre charge for varying field activities. So we take it by practice, by acre.
Right.
So because you never know what's going to be needed in a year. So I think you got to see what actually had to take place and pay accordingly.
All right. So we are going to move on to our last topic. And this is just, by the way, this could be a whole webinar in and of itself, but here's what I would like you to think about. If you're selling farmland, calculate and understand taxes before you sell it. Because there could be capital gains. There likely will be capital gains. There could be state taxes associated with that. We may go, Jim told us we may go a little over. We're going to do 3 or 4 minutes overtime on this. If you want to leave, you guys can leave anytime you want, but we apologize. Calculate and understand the taxes before selling the farmland. I would also tell you, if you're thinking about taking farmland and moving it into another investment, make sure that you understand the profile of that return, that alternative investment. And if you understand that, go for it. But often the alternatives don't have make sure they have a risk return profile that you want. And if your goal is to sell it and have fun with it and consume it, just go for it. That's quite all right. But again, think about the taxes and the alternative investments. Luke, what other things?
Yeah, I guess, real quick, other things to consider is, a lot of times too, land is owned by LLCs. Every LLC might have unique operating agreements. A lot of land is owned by trusts, and certain trusts prohibit certain activities by the trustees or beneficiaries. So just make sure you have all you have all the boxes checked before you move too quickly on a sale.
Yep. Transferring farmland from one generation to the next. Again, everybody, that's a big deal, and it has to be a part of an estate plan. Generally, if you own a farm, you really do need to think about this as a total estate plan setup. There are some favorable tax implications of transferring farmland from one generation to the next, and that includes a step up in basis. And if the next generation decides to sell it, they would have a step up in basis, which again, not to go into too much detail here, but as you're doing the estate plan or thinking about that can be a big deal. And this is my bias, but if at all possible, give it as an undivided interest to the next generation. And just a little bit of background there. You can give it as an undivided interest and equal shares. You can divide it interest, divide farmland and give each heir their part, and a landowning entity. Here is some of the observations that I would have, particularly if you're transferring this to your children or next children. Your children and definitely grandchildren will likely have less attachment to the farm than you do. And I would suggest not planning for that farmland to remain in the family indefinitely. And a number of times when you try and manage the heirs' affairs from the graves, that ends up in problems along the way. Luke, anything you want to add?
Yeah, I'll be very brief because I could ramble on and on about this, but I will echo your comments on divided interests. I think even if you have a wonderful family relationship, I still think that could be a very proactive way to enable future generations to have a harmonious relationship. I'll use my own personal family as an example. My father and my uncle have a great relationship. But when they inherited land, they had an agreement that Dad got his, and my Uncle David got his, and the cousins, meaning me, can just still be cousins down the road. I think a lot of times you have family members that are thrown together in some sort of business relationship, and then everybody realizes, oh wait, the old farm is worth $2 million. That's complicated, right? That's complicated. So I would echo your sentiments on divided interest and to be proactive.
We'll answer these couple questions.
Okay.
On the custom farming leasing situation, we do at the University of Illinois. Actually, I help with this, so we put out a cost of operations guide. If you know what operations that you need to perform, you can add those up. For example, we have planting, we have each tillage operation, and we have combining. So you can add those up to get an idea of what a custom farming charge should be. With interest rates higher, how much is this figured into the terms of cash lease? For example, only 20% down in March and balance in December. Luke, does the interest rates come into your consideration of 1 or 2 times per year?
We really haven't, but I mean, again, it kind of comes back to it. I mean, there is no set criteria. You can explore these things, but personally, I do not have experience with that.
One of the things that I will tell you, one of the reasons why you want it up front as well is that it reduces the risk of getting the last payment as well. Not that that's a big risk, but it has been known to happen in the past. And we're just seeing interest rates rise again, so we really don't know what's going to happen to those rates. If I, as a landowner, wish to improve my farm with pattern tile drainage and negotiate annual cash rent rates, how do I share in the cost and benefits of this improvement with the tenant? So, Luke, this has been a situation you've had to come up with.
Yeah, so you can look at it a couple of different ways. Typically a large, capital improvement would be at the seller's expense. If you have a good relationship with your grower and you don't see that changing, I have been a part of agreements where the tenant would share in that expense, and then you almost kind of treat it. Uh, Obviously, it's not apples to apples, but we talked about limestone, right? How you can prorate that over a set period of time. Certainly, with field tile, you would prorate that over 4 years, but I've seen agreements where a grower would participate in a project and then have his cost prorated over, 10, 12, 15 years. So that way, let's say he did contribute $70,000 to a big project, but for some unforeseen circumstances, he only farmed it 4 years after that. There would be some sort of, repayment. So yeah, there are different ways to do it. And sometimes that's a good way to get something done because those projects are not cheap. And so that's a lot to ask just one party to foot the bill.
So have you seen an increase in LLCs set up to jointly own and manage a group of heirs of a farm, or is a trend move towards selling off the farmland entirely? Well, I don't know of any statistics that give that detail.
Luke? This would just be my gut. This would be my gut answer. I would see more farms sell for settling of estates and siblings or family members kind of go on their own way. I see that more than I see the establishment of an entity to maintain ownership.
Well, how do you ensure that the tenant maintains or approves soil nutrients in a year-to-year cash rent? There are a couple ways that I've seen this, and one is to have the farmer provide you with an invoice on fertilizer applied to the farm. The other one is to have soil tests done periodically. And that's probably the best way, is to have soil tests, and the landowner would need to look at those soil tests and look at what has happening to pK and pH over time. Luke, you want to add anything there?
Yeah, I would say maybe even a combination of both. I think regardless, having a baseline soil test done every few years is wise. And I think we do have leases, cash rent leases, where we build in language that, at owner's request, owner or manager should be provided invoices for, fertilizer and other things that can reassure that the farm is being taken care of. I think that's important too. If you're going to try to do a cash rent and you're not using a farm manager and you're not local, I think that's wise to have in your leases. Otherwise, what else? What are your other options to try to, not that you want to be untrustworthy or untrusting, I should say, but it's good to have in there. If you have doubts, you have the right to ask for proof.
As Ronald Reagan would say, trust but verify. And with that, all right, Todd, we are coming to
wrapped it up. Thank you very much. I appreciate it. Luke Worrell is with Worrell Land Services. He's out of Jacksonville, Illinois. And of course, Gary Schnitkey is with University of Illinois Extension, an agricultural economist here on the Urbana-Champaign campus of the U of I. Our sponsors for the program today include the TIA Center for Farmland Research, Compere Financial, Corteva AgriScience, Farm Credit Illinois, the Illinois Corn Growers, the Growmark and FS companies, and the Illinois Soybean Association. Our FarmDoc educational partners include Illinois Extension and the Department of Agricultural and Consumer Economics. We have a couple of upcoming webinars yet. You've seen those already. Next week, we'll talk about nitrogen fertilizer decisions for 2023. That's on Thursday at 11 o'clock. You're already signed up for both of these, and you'll get information in your email. And then on November the 10th, the Farm Tax Planning Strategies webinar will come up. and you'll want to be in attendance for both of those. On behalf of Jim Baltz, who's behind the scenes, I'll remind you that you can see these programs anytime you'd like, again, up on the webinar archive section of the FarmDoc Daily website at farmdocdaily.illinois.edu. Look under the webinars/IFAS program. You'll also find a link to the Farm Assets Conference, and you can sign up for it. It's coming up in person at the iHotel on Monday, the 21st day of November. That's the Monday of Thanksgiving week. And Luke Worrell will be there along with Gary Schnitkey and so many more. FarmAssetsConference.com if you can't remember or find it at the FarmDoc Daily website. Again, FarmAssetsConference.com to get signed up and registered for it. Thank you so much for being with us. I'm University of Illinois Extension's Todd Gleason.